Hello everyone, and welcome to this BCO NextGen webinar. To briefly introduce myself, my name is Tom Bremner, and I'm one of the NextGen committee members in London. I'm delighted that you can all join us today for today's presentation, which I'm very pleased to say will be hosted by my colleague, Heena Gadhavi, who's part of the Cushman Wakefield research team. The focus of today's webinar will be on the central London occupational market, specifically how the macro environment is likely to impact market activity. Heena and myself are very happy to field any questions you may have at the end of the presentation, which will be roughly 20 to 30 minutes in length. If you have any questions, I'd be grateful if you could submit these via the Zoom chat, and I'll cover these off in the Q&A session at the end. So without further ado, to kick off, Heena, I'll pass over to you.
Thank you, Tom, and morning, everyone. So as Tom said, my name is Heena, and I work in the UK office's research team at Cushman Wakefield. Today, I'm just going to go and give a quick run through of our latest stats for Q3 for Central London, and then talk about some of the economic headwinds that we've got facing us in the UK and how that is likely to impact supply and demand dynamics of the occupational market. So first, let's have a look at take-up. 2.7 million square feet of office space was acquired during Q3, and that took leasing volumes for the 9 months of the year to 7.88 million square feet. This was around a third higher than the same period of 2021, which is easily visible through the chart there, and 11% above the 5-year Q1 to Q3 average of 7.1 million square feet. So all in all, I think you can say it's been a pretty successful year so far. A further 633 square feet completed in October, and having a look at the November stats just yesterday, another 643 square feet has already closed. So actually, year-to-date figures total over 9 million square feet for West End City and East London, and that's far exceeding the full year figures that we saw last year, which were 8.6 million square feet. And when you think about it, we've still got 1 month to go, albeit it's a shorter one in terms of working days. If I quickly move on to the volume of space under offer, you can see on the chart, there was over 3 million square feet of office space under offer at the end of September, and that's since increased to 3.4 million square feet as of yesterday. So there's still a lot of space awaiting completion when comparing this to the historical context. But given the churn of completions that we've seen in recent months and quarters, you would expect much of that to close within the next 6 to 9 months. So what are the main drivers of demand in the market? Pre-letting activity continues to be a strong driver, and the larger pre-lets are key in bolstering those take-up figures. You can see from the chart that on the left that 28% of take-up Q1 to Q3 this year was pre-let, and that equates to around 2.2 million square feet. Another 550,000 square feet has since been pre-let in October and so far in November, and so that takes that proportion up to 30%. Equaling those proportions that we saw back in 2013 and just before the pandemic in 2019. So still very, very important for the market. In terms of sectors, the traditional sectors continue to be key, with banking and financial, professional services, insurance, and legal firms accounting for over half of total take-up for Q1 to Q3 this year. Without these sectors providing that churn, take-up levels will be significantly lower. Media and tech firms also continue to be really active, having taken a 19% share this year. That is behind the 25% market share that they had in the last 5 years, aggregated, but still positive and important for the market nonetheless. Noticeably, you can see from that sector split chart on the right-hand side, flexible workspace providers have seen their share of take-up drop off this year. It's that sort of light green color, and that's marked 4%. After their drive in acquisitions pre-pandemic, it's not a shock to see that their share is limited now, with the whole work from home and work from office aspect still unknown for some occupiers. So I can understand why some of these providers have held back in acquiring space this year, but it's definitely an interesting sector to keep watch of in the coming months and quarters, particularly as we enter that period of economic uncertainty, which I'm sure everyone is well aware of. So, what is the state of the UK economy right now? On this chart, I've highlighted some of the major economic events of the last 15 to 20 years. You've got the global financial crisis, the EU referendum vote, and of course, COVID-19. Now, there are, of course, many other other macro events that occurred during this period, but these are, I guess, the main three that stand out. In each of these events, demand for office space in central London was impacted. We can't argue with that. However, in all of these cases, while the economy has taken some time to bounce back, the central London office market actually hasn't. In fact, at most, the market's more or less rebounded within 2 to 4 quarters. However, we've never been in an economic position as we are in right now. There isn't just one or two factors which are at play as per the previous economic downturns. In fact, there are at least 4 or 5, some of which I've listed on the slide. Given what we know right now, it's not a question of will the UK enter into a recession, it's more of how long will it last. Now, I am by no means a forecaster or an economist, and I'm very glad to not be one right now. But looking at these externally sourced forecasts from Moody's Analytics over the last few months and quarters, it's clear to see that the level of uncertainty within the market, and with the forecast continually having to be revised quite significantly in some cases as more events or factors affect the outlook. And just to put a bit of context to that, back in June, the energy crisis and rising inflation was firmly driving that outlook. But by November, the addition of the mini budget impact, the government turmoil that we've all seen and heard about in the news, and the subsequent rising of interest rates and a mortgage crisis have all been added to that list. And as you can see from the chart on the left, the UK's GDP forecast for the next 5 quarters has been downgraded as a result. Now, if we look to the chart on the right, and you look at the current baseline forecasts, which are in blue, and those are the forecasts as per the November iteration, we have 2 additional scenarios that can play out from that baseline, which are highlighted in the grey and in the red on the chart. The first is that scenario of stagflation, which I guess is one of those buzzwords that's popping around in the economy sphere at the moment. And that is where slow economic growth happens in tandem with joblessness and rising inflation. Although once thought to have been an impossible scenario to be in, given where we are in the current economic climate, the chances of this occurring is likely if unemployment rises, which at present has not been the case. The second and worst scenario is a recession, which we already know is likely to occur. The red line forecasts the worst case scenario of a prolonged recession lasting for more than 2 years, which the Bank of England warned could be the case in its last MPC meeting in early November. Now, if this scenario were to play out, the UK would face its longest recession since records began. And add to that the upcoming general election in 2024, which will provide its own problems for the incoming winning party. The Bank of England chose to raise its interest rates for the 8th time this year to 3% in November. So let's hope that we don't get to that worst case scenario and we stay closer towards that baseline. Now, I realize that that last slide was a depressing one to hear about. We can't shy away from the issues that we've got facing us ahead, obviously, but it's important to point out that with this economic uncertainty also comes opportunity. So hopefully the next couple of slides will be a bit more positive and less depressing to hear about. So we know inflation is rising, and the November iteration of the forecasts are broadly in line with those that we saw back in June, and markedly better than those that were in August over the summer. The clear differentiation between the current figures and the previous 2 versions is that the downward trajectory to 2% is likely to be slower, most likely getting there at some point in 2025 instead of mid to late 2023, as was previously expected. But the fact that we are thought to have reached the peak in inflation is a positive outcome to take from this, as the only way now is down. On the right, we've got a chart there that shows a bit of a breakdown on the causes of inflation. Now, it won't be a shock to see that the cost of goods has been the main contributor, more specifically the price of energy and food and beverages, which I'm sure we have all been hit with in some way or another. While the price of fuel for cars isn't as low as it was during the pandemic, it has reduced in recent months. So that's another positive to take away from that. Now that we are well and truly into the winter months, consumers will start to see the cost of gas and electricity increase naturally, but that rise is expected to be much greater than this time last year. However, the government has offered grants which will go some way in helping us get through the next few months. If we were to remove both energy and food and beverages from inflation, CPI would still be around the 6% mark. It's still higher than we've been used to seeing, but clear evidence of the factors that are driving up consumer spending at present. I missed one. No, there I am. The other positive, I guess, to take away is that conversation around office-based employment in London, which is what this chart is showing here on the screen. Now, this metric dipped in 2020, which was expected to happen because of the pandemic. However, it has since rebounded, and the number of positions now available has surpassed that pre-pandemic peak. And while the number is forecast to rise over the next 5 years for all services, the growth is evidently stunted. But growth, no matter how large or small, is a positive thing. Looking at some of the sector breakdowns there on the chart, positions in the finance and insurance sector are expected to continue falling, in large part due to the offshoring of those positions that we've seen in recent years, with many of those positions having been relocated to more cost-effective office locations outside London, and in some cases outside of the UK, which is a reflection of that reduction that you can see in the blue line. In the professional services sector, the number of positions is expected to increase by 25,000 new positions over the next 5 years. It is marginal when you consider the 77,000 increase in new positions over the previous 5 years, but growth is growth and we welcome it nonetheless. As we all know, employment isn't the only factor that will affect demand moving forward. And the number of employees returning to the office will also be key for businesses when deciding whether or not they would like to expand or consolidate their existing office space. As you can see from the chart, the number of journeys taken on TfL's network, it's now at the highest level since before the pandemic. So the worries or misconceptions around people traveling to the city appear to be winding down. I will point out that this data also includes journeys outside of office hours. So whilst confidence to travel to London has returned, the data and consensus around the return to the office is somewhat patchy. There are some data sources that are stating office occupancy across central London are between the 30 to 40% mark, with fluctuations across the different days of the working week. So actually, for businesses, it is as hard determining their office requirements now as it was earlier this year when we still had the uncertainty around the pandemic and the work from home and office requirements. And many businesses must accommodate space for their busiest days, even if that capacity is only reached once or twice a week. It does mean decision-making is very difficult at the moment, and requirements for space are continually changing. So all that being said, how will this outlook and different dynamics affect supply? So I thought these charts were very interesting to show. This is looking at the number of requirements currently in the central London office market, both in terms of volume of space they are seeking and the number of requirements. And you can see that at the end of September, there was a sharp increase to just over 10 million square feet of active requirements across central London. However, it's that mid-sized bracket of 10 to 50,000, which you can see in the grey and the red bars, that has seen that noticeable increase, which is interesting because the proportions for those size brackets has also never been higher. So actually, with requirements up, the potential for future demand is also good. It would be very interesting to see what the drivers are for those within that size bracket. Is this occupiers looking for expansion or consolidation space? Or are these requirements driven by lease expiries, for example? While I don't have the answer for you right now, it's definitely something to keep stock of. And based on current sort of supply dynamics and the volume of supply that's in the market, which I'll get to shortly, there is definitely enough in the market within that size range that could satisfy some of this demand, but it's never that straightforward. So that takes us on to looking at what the current supply levels are at present. And at the end of Q3, there was around 25 million square feet of office space available across the market, of which 10.3 million square feet was classified as grade A. This is a historic high for the market, and it equates to an overall vacancy rate of 8.8%. On the grade A space, while the actual volume is still very high at around 10 million square feet, it accounts for 41% of the total supply, which is actually the lowest proportion since the early 2010s. But moving on to that chart on the right, the gap between grade A and second-hand space has widened in recent quarters, reinforcing that flight to quality trend that many commentators have spoken about, certainly within the last 12 to 18 months. The gap is around 4 million square feet between the two, and is as high as we have ever seen since we started recording this data. When you think about it, with 10.3 million square feet of grade A space available and 10 million square feet of active requirements in the market, there is enough supply to satisfy that demand in theory. But we all know it's not that straightforward. Occupiers are increasingly looking for more than just the traditional office space with desks and chairs. And the amenity value, both in the office and in the surrounding areas, has become front and center for many seeking space in the market. But I'll come back to that shortly. There is a clear mismatch at play here, where we have, at the start of the year anyway, rising supply, rising demand, and rising rental values all occurring at the same time. As you can see on the chart, it's something that the market has not experienced before. And all this at a point in which the downturn of the economy is occurring. So there is definite difficulty in predicting what happens next. At the start of the year, a lot of this mismatch in supply and demand could be put down to that release of pent-up demand from 2020, when transactions were halted. So the market was still effectively playing catch up. There is still an element of this at play, but some normality to those traditional dynamics does seem to be happening now, with the 12-month rolling take-up reaching a sort of equilibrium with supply in Q2 of this year, and then beginning to diverge in Q3, as you would expect in a traditional marketplace. And this dynamic will be key in driving pricing levels, as has always been the case. I guess it's sort of fair to say that we're in an era of market change, and the evolution of the office space itself, which is also at the front of developers' minds for new developments across the market, and that will ultimately continue to drive pricing levels as well. And moving on to future supply, the initial first glance appears to look positive, with a solid stream of office stock expected to enter the market in the next 5 years. Now, this data covers all office developments within West End, the City, and East London as well. And there is a lot of space that we can see should be delivered by 2027. But when you look more closely and strip out the pipeline space that has been pre-let and is no longer available, or where construction has not yet started, the reality of that future supply constraint is apparent. There are questions around the rising cost of construction and how this will impact future supply. The viability of developments, including those that are under construction and available, are also being questioned, and so are those where construction hasn't started. We may be in a position that pre-let commitments are required in order for developments to commence or continue, in which case we could see some of these deliveries earmarked for 2023 and 24 shifted out further. So if I go back onto the requirements just for a second, many of those larger requirements in the market are for grade A stock. and the new build space that is currently under construction is likely to be the first choice and target and snapped up quicker than the existing grade A stock that we've got in the market. So again, that highlights the importance of pre-letting activity for demand. This slide is looking at the rental uplift that is required for development viability. Now, Oxford Economics, they conducted a study looking at the rental value increase required across some of the different sectors and different locations to ensure viability. And according to this, on average, city office rents would need a rental uplift of around 9% by the end of 2023 to ensure its viability and keep pace with the rising construction costs. It's a sobering thought when you think about it, because actually, what are the chances of rents increasing that much and occupiers accepting those rents? It's very easy for us to talk about the prime end of the market, but actually the new MEES regulations, which are going to come into force over the next couple of years, picks up everything that is outside of prime, essentially, which is a large proportion of our existing stock. This slide is looking at the proportion of EPC grade A and B rated buildings across the different submarkets of London. And as you can see, these percentages are very low. In fact, you've got Hammersmith up there, which is leading the way, but it's just under 7.5% of its stock is at that high rating, which means everything else is grade C or under, and landlords will be required to bring these up to standards, which of course cost money like everything else. So it's not just new developments that are being influenced or affected by the current rise in construction costs, it's actually existing buildings as well. And these would need to be brought up to standard by the time these regulations come into place. And I know they are phased. I'm not an expert on MEES, but I know that the timelines for this is all phased. So you've got to bring them up to C, and then following a few years, it'll have to go up to A or B. But actually, if you're going to do the work to bring these up to standards, and if you're in a building which is grade E, for example, are you going to spend that money to bring it up to C to meet the requirements of the first phase, and then spend more money to bring it up to A? You would essentially hope that people are going to be going from E to B or A straight away, skipping out that middle phase. So all of that ties into the cost of development, the cost of construction, and bringing up our current office stock to where it needs to be to comply with rules and regulations, but also to meet the needs of what occupiers are increasingly looking for, which is high quality space. So knowing what we know about economic growth and inflation forecasts, the rising cost of construction will impact both existing and future stock. And to mitigate this, we expect rental values to increase. And that has been reflected in our forecast for the next 5 years. However, that rate of growth is likely to be held back and not as strong as we've seen in previous property cycles. By 2024, prime rents in the city are forecast to reach £74 per square feet from £72.50, which is where they were at the end of Q3 this year. And in the West End, rents are expected to go from £120 per square foot in Q3 this year to £124 by the end of 2024. Moving on to that chart on the right, there is clear evidence of the gap between the best versus the rest widening. That chart shows is an analysis of achieved rents in the market. So not prime, not anecdotal, but actual achieved rents. The average of which is in that grey line in the middle, with the top and bottom 10% in the blue and red lines. Back in 2010, that gap between the average and the top 10% was around £25 per square foot. And this is almost doubled to £49 per square foot at the end of 2021. That rate of widening is likely to increase further, both in 2022 and over the next coming years, with the evolution of the workplace and office driving this differential in pricing. And finally, in that bottom 10% of the market, you would expect much of that stock to be developed or become obsolete, in which case average achieved rents will continue to move closer to zero. So what does this all mean for demand? In the city, on the left, The pre-pandemic 5-year annual average was around 6.5 million square feet. And for the West End, that figure is just below 4 million square feet. And it's quite evident and clear to see just by looking at the two charts that there will be a dip in 2023. And that's around 20% below the average for the city and 15% below the average for the West End. However, growth demand will return from 2024, albeit at a lower level than we've sort of been accustomed to. However, this is the new normal for transactional activity in central London, which isn't necessarily a bad thing. The market and the people who work within the market and the people who are involved in the market as a landlord, developer, and occupier, they are continually having to adapt to these changes of the office in terms of occupancy and also the workplace itself. And in doing so, the transactional activity is obviously likely to be impacted. So we've gone from a sort of a pre-pandemic phase where the office was just desks and chairs, which everyone was sitting in 5 days a week. Now the office has to be more, and in order to get it to that more requires money and investment from landlords, from occupiers. You know, occupiers want to have a space which promotes inclusiveness, which promotes collaboration. And in doing that, and in requiring that and wanting that, investment needs to be made into the building, into the fit out itself. So I think it's fair to say that the office is changing. It has been changing for the last 12 months, as we've all noticed anyway, but we're going to see that change exacerbated over the next 5 years. And because of that, the volume of space that an occupier might acquire might be lower, but they will be seeking and looking for that best quality space, which is not in abundance at the moment, but we hope will be with these new developments that are coming through and with these regulations that will help to drive that change. And I will leave it there.
Great. Thanks, Heena. That was very informative, as always. So everyone, yeah, if you've got any questions, be very grateful if you can just enter them into the Q&A box. I'll just start off with a couple. So in terms of take-up, Heena, where do we potentially forecast that to be next year, especially when you consider the macroeconomic and geopolitical pressures that we're currently facing?
So that last slide was sort of splitting out City and West End. There is looking on average around a 25% reduction of levels that we've seen prior to the pandemic. We've already seen that forecast shift down anyway since 2020. You know, we had the highs of 2021, which was 8.6 million from memory, but it was never at that level, and it was very difficult for it to get to that level that we were pre-pandemic, when you were seeing around 9, 10, 11 million square feet trading in one year. But we are going to see that drop off next year. But the most important thing to note, I think, is that it's going to be a year where it's fallen, and then we're going to start to see it tick up again.
Yeah, makes sense. And just going into the take-up figures for this year, I think it was 3 million square feet in central London is currently under offer.
Yeah.
First of all, does that include option space? And if so, how much of this do we think will actually be taken up by firms?
It includes option space, it does. I think where firms have already committed to large volumes of space, we need to sort of navigate the next couple of months to ascertain whether that option space will be taken up. So a lot of that might remain under offer or in the stats for at least 6 months until there's a bit more clarity on how the economic environment is going to change dynamics, change staffing requirements, change everything. So it does include the stat. It is included in the stats, but I think we just have to be mindful that it will probably remain in the figures for the next 6 to 9 months until we know a bit more about how the economy is gonna come out of this recession, how employment is going to be affected in this after this or during this recession and after.
Okay, perfect. How do we think the recession and current inflationary pressure will affect return to the office?
Oh, That's a tough one. Sorry, can you repeat that? How do you think
how do we think the current recession and inflationary pressures will affect the return to the office for staff, I assume? I guess talking about unemployment or likely unemployment.
Well, I think we've already sort of seen it in the media that companies are doing cost-cutting exercises. It's happening within our industry as well. And that's all sort of known to the public. There is an element of people requiring job security, and it may be a part of that might be that they would want to show face a lot more in the office to make it known to their employers that they are still there and they're still present and they're still doing the work that's required of them and more. And because of that, I think you might actually see a lot of people coming into the office more than you might have done otherwise. But that's only one element of it. I mean, it's very, very, very rich of me to say that while I'm sitting at home. But you're in the office, Tom. Is it busy? It's busy, isn't it?
It is busy, yeah. It's the energy bills are probably cheaper in the office than they are at home as well.
That is
the reasons why
I actually think we joke about it, but I do think that is probably a big reason as to why people are coming in. I think in terms of people having the setup to work from home, everyone or most people are pretty much there. We've had 2 years of this now, and people have probably got their workstation set up comfortably. If anyone's like me, I like to come in maybe 2 or 3 days into the office, A, for a change of scenery, B, to sort of be with my team or my teams and to see people. So it's the social aspect, but also to allow to collaborate. And when you're in this sort of uncertain time, I think being in the office is probably more important than anything, because there might be fewer staff because of cost-cutting exercises. So there's more is required for the employees who do come in. But I think it's also nice to take a break from your usual 9-to-5 setting if you're at home 5 days a week. It's only going to be better for your mind to be refreshed, to think of new ideas and to do analysis or research or work that is probably more conducive to what everyone wants to hear, what clients want to hear.
Yep, absolutely. And you obviously touched on briefly in your presentation the rising construction costs.
Yeah.
So how exactly do we see this affecting the development pipeline going forward?
I do think so. The schemes that are under construction, I mean, those are all pre-committed to deliver. I mean, you would probably see this more, Tom, than I would, but there might be a certain degree of developers maybe pausing to wait for pre-let commitments before continuing, because they want to know that once that building is finished, they've got someone who's moving straight in and they can start getting the rental income from that. And what developers won't want to be left with is a brand new shiny building that's complete but with no one to move into. So that's the sort of stuff that's under construction. It's not going to happen to all of it, but maybe some of the larger schemes, if you're not going to get a pre-let, 100% pre-let, at least if you're getting up to 30-40%, it means there's a reason for them to carry on. And then on the stuff that hasn't started, obviously the materials and the cost of construction that was originally allocated at the start of the development phase can probably be thrown out the window at this point, because things have gone up so much. The price of concrete has gone up like 20% or whatever it is. So I think that those are the schemes that we need to be more wary and mindful of. And again, are going to be, a lot of them, I think, will be required to have those commitments from occupiers in order to maybe ensure that the developer can keep building it. But I think for me personally, it's an exercise that I want to look into to see how many of those developments are actually going to start, and are actually going to complete at the time in which they were forecast to complete at the start of its inception. But I'm sure you're seeing more of that in the market than I am.
I certainly think there's a lot of large schemes which otherwise we had confidence would be built out, will probably most likely push a few years back. And you might see more refurbishments and value engineering on current proposed schemes.
Well, there's also, if a developer were to press pause on a scheme that hasn't started, they might be waiting to see, waiting for that period in time where costs have reduced slightly before pressing start on the development again, pre-let or no pre-let. So, costs have to come down at some point. So it's just a matter of how much they're going to come down, and are we going to see that level of construction cost that we've seen in the last 12 months, or are they just going to remain consistently high? I mean, this is where I'm glad I'm not a forecaster.
I agree with you, absolutely. And then just a couple more from the floor. So regarding EPC analysis, and I appreciate your role isn't a sustainability expert here. We could certainly help you out with my views from an agency perspective. The question is, will we see landlords having to refurbish buildings, or will there still be a lot of demolished and new build buildings? I
think landlords will probably, it depends on how obsolete the building is currently, obviously. My personal view is that I think there are certain targets that you have to hit in order to get to a grade B or an A in terms of EPC rating. Someone once told me a month or so ago that I think if you automatically put solar panels on the roof, then you would automatically be bumped up to a B, subject to other aspects of the building, obviously. But you can't get to a grade B if you don't have, or a grade A if you don't have solar panels, for example. So I think depending on, again, it goes back to cost. How much is it going to cost to get these buildings up to that standard? And if landlords can do maybe the bare minimum to ensure that they get up to that, then they probably will refurbish. It's slightly difficult when you think about knockdown and rebuilds, because especially in the West End, you've got so many listed buildings, you've got so many restrictions on that. So it's not always the easy case. And, we all know that knocking down and rebuilding is going to be tenfold more expensive than doing a refurb. So it will be based on an asset by asset basis, and the current condition of the existing premises. But it will definitely, I think, because of the cost implication, there will be an aspect of, let's do the bare minimum to get to where we need to get to, and then potentially increase that. If construction costs reduce, for example, if we can invest, if a landlord can invest more into the business, then albeit then fair play.
Yeah, 100%. I think it does go back to the cost point, and it will be done on the feasibility of each scheme on a case-by-case basis. And I think with rising costs at the moment, and landlords' ability to hit MEES regulation by refurbing existing buildings, they're probably more likely to go down that route, depending on the feasibility of the scheme. So I think that's definitely right. We've got a couple more. So just in terms of active demand, with the value and stock prices of technology firms currently falling, obviously we're seeing news articles about Salesforce, Google, et cetera, in the news at the moment. What sector or sectors do we think are most likely to fill the hole with take-up that the tech companies will otherwise leave? That might not actually be a definitive answer.
No, that's future gazing. Because I guess before the pandemic, no one really saw workspace providers falling off as they would, but changing market meant that they had to adapt, and the way that they acquired also changed. That's why their take-up proportions are so low. I kind of alluded to it earlier in the presentation, I guess, but I think those traditional sectors are going to be key in keeping that demand churning. So professional services, finance, insurance, legal, what was the other one? I can't remember. But those sort of traditional sectors, historically, even during a market downturn, they might have reduced the type of space and the volume of space that they're acquiring, but they are still active in the market. I think that's key. I think what we might also see is firms start to consolidate space if they've got various different offices located around London. So maybe acquiring one larger office and bringing everyone in from the smaller offices that they've got dotted around. So again, I think that I would, I don't want to put a sector to it, but I would say just, your traditional sectors will help to keep that churn, and then the bonuses and the benefits and the spikes are going to probably come from those larger media tech firms, maybe a workspace provider if that starts to lift off again. But London will always fall back to its traditions. It always has done in most of the economic cycles as well.
I think we're seeing that in the market, absolutely. I think with as you say, the tech companies traditionally have always been expansion led with their take up, and historically we've seen them, companies like Amazon, Google taking 100,000 square foot or so every single year, a lot of the time for jobs which aren't even invented yet, and that's unfortunately dried up. It would be lovely if that did return, but at the moment there's no forecast for that. In fact, I do think that some of those bigger tech firms will actually drop space potentially next year, and that actually could have quite a significant impact on the supply dynamics in London.
Yeah, definitely, and it goes back to what I was saying before. When demand goes up, in theory, supply should come down, because you're offsetting that space, but we're going back into that from about this quarter. We're going back into that dynamic of the market where supply is on the rise and take up is moving away from it, it's diverging away, which you would expect with traditional supply demand dynamics. So that's where our forecast is sort of born out of as well, that there is going to be that reduction. I think consolidation is something that's going to happen, and it's not going to and it's going to be a prolonged period of consolidation for some companies. Obviously, all that being said, a lot of that is driven by lease expiries and breaks and being able to get out of your current lease agreements. But yeah, definitely consolidation is going to be the theme for next year for many occupiers, I think.
Perfect. Okay, I'm looking at a couple of things. I think the other questions we've touched on all of those. So I think we'll probably call it a day for today's webinar. I just want to thank everyone for attending. I hope that was informative and useful. And yeah, hopefully we'll see you on another one soon. Perfect. Thanks everyone.
Thank you very much.